Hi everyone, David Blaine here. Continuing with our series on 2020 review and 2021 outlook. So this video, I'm going to talk a lot about what happened in 2020. For some of you may not want to listen to this if it's too painful. I know as I was making some notes to myself for the year in review, it was like, wow, that was this year. And in some respects, it seems like yesterday. Other respects, it seems like it was another time, another year. And in other respects, it seems like, was I really part of that? Looking at the figures. But anyway, so obviously the big event for 2020 was the coronavirus pandemic that took hold. And I'm not going to get into the epidemiology of all that and mask wearing or not mask wearing and all that sort of stuff. I'm going to focus on the effect it had on markets and the economy. So it was the deepest recession in modern history, believe it or not, in terms of recessionary, the downfall of growth when government shut down the economies, the decline in economic activity was the worst recession in modern history. It was also the shortest. That after the initial couple of months of shutdown and economic activity plummeted, 15, 20, 25%, 100% in some sectors, travel, airlines, hotels, things like that. Governments realized that, hey, we're not going to survive this no matter how much money we can print. And so things gradually started opening back up. So it was the shortest recession, one of the shortest, but it was also it was the deepest in modern history. It was also unprecedented government stimulus and central bank action. We had the financial crisis of 2008. And back then, for those of you that were clients then, you remember I was certainly doing this job back then, was well involved in that crisis as well. My gosh, we thought the stimulus packages that were coming out were tremendous. Like, who would ever think of $1 trillion stimulus package? Well, the COVID government stimulus, both in the US as well as the European banks, the Bank of Japan, China, the fiscal stimulus was just tremendous, trillions and trillions of dollars. Central banks cutting interest rates, if they hadn't already, down to the bone. We saw central banks purchasing bonds, which is something that they do to prop up the markets as they'll go into the market and they'll actually purchase the bonds. So unprecedented government stimulus and central bank action. We're actually going to talk about that in my 2021 outlook. So just kind of a teaser, I'll be doing that 2021 outlook next. And I think that stimulus is probably going to continue for a while. So in terms of the market, the stock market we'll talk about, the high was February 12th, was when things started getting a little bit crazy in the markets, February 12th, 2020. And it ended on March 23rd. So we had a bear market that ran from February 12th to March 23rd. During that time, the S&P 500 lost about 34% over 40 days. Very sharp decline. Once again, very short, but a very sharp decline. So that's for the S&P 500. The other asset classes, the NASDAQ, the European, Chinese markets, they were all, different numbers, obviously, but somewhat similar in duration and intensity. But just to let you know, in case you forgot, on the 9th of March, the S&P 500 dropped by 8%. 12th of March, it dropped by 10%. And on the 16th of March, it dropped by 13%. People really thought the world was coming to an end at that point and that economies were going to collapse. So what's the lesson from this? And I've been doing this for over 21 years professionally, and as a private investor, even most of my life that I can remember, I've been investing. And one of the principles that I adopted early on is don't try to figure it all out yourself. There are too many variables, there's too many emotions at play. And this is a perfect example, is by the time people figured out that markets were crashing and they were bailing out, the markets were already recovering. And so you want to have an investment strategy that you can live with, that you can go through a 2008, 2009 recession. You can go through a COVID panic and you don't pandemic and you don't panic. That's the key. The key is not trying to figure out when to get out, when to get in, those type of things. It's having a strategy that you can live with. And as I mentioned in my overview video, we took advantage of it. We did heavy tax loss selling. We took some tax losses for people that they're going to see the benefit of that in April. And so use that decline to your advantage, but be in a strategy that you can live with. It wasn't just confined to the stock market. As you recall, oil declined. It fell 25% in one day. March the 6th, oil fell 25% in one day. It became a quarter less valuable. April 20th, oil had a negative spot price. What does that mean? It means that the oil companies had so much oil, not the oil company, but the drillers and the refine, they had so much oil that they couldn't get rid of, that they were willing to pay you to take the barrel of oil. That's what a negative spot rate means. Unprecedented, never happened before. The decline in economic activity came so swiftly. And then Saudi Arabia and Russia kind of got into a little spat about who was cutting production and who wasn't. It just really collapsed the oil market. Now, the price of oil for the year was down. The energy sector and oil in the latter parts of the year is one of the best performing sectors. Once again, hard to predict that going into 2020. Certainly hard to predict that when the price of oil is collapsing. Although I will say a negative spot rate on oil was probably a pretty good time to buy oil. Now, we don't speculate in commodities. There's a lot of risks, a lot of reasons that we don't really, but if I was in the commodities market, I would certainly be buying with a negative spot rate. Just the fact that it went negative is pretty crazy. So from that March 23rd low, the S&P 500, which is the United States stock market, the 500 largest companies in the US, is up 70%. 70%, that's as of today, from that March low. Once again, it's very difficult, almost impossible to time that. And you're going to read, about some guy on Wall Street or something that timed it perfectly. He's also going to be the guy that you're going to read about 5 years from now that got the next crisis completely wrong and is shutting down his hedge fund because he lost everyone's money. And that's true. That's exactly what happened. All the people that called the recession of 2008 and thought they were smarter than everybody else went out and set up these hedge funds, and most of them are out of business now after having lost a lot of money for people. Technology was the story of 2020. It was already doing very well, but of course the pandemic accelerated the adoption of technology, the work from home, shutting of offices. And so technology companies really benefited from that in 2020. We also saw somewhat of a resurgence in small caps. Small caps have been struggling for a couple years as compared to large tech, but we did see a resurgence of that. Government stimulus, getting some money into the hands of smaller businesses was good. And as a typical pattern of coming out of recession, smaller companies are usually a little more nimble, able to react to the economy, able to react to the economic fundamentals that are going on. And so you generally see a little bit of a boost for them. And we did see that. We saw some outperformance by small caps towards the end of the year. The growth versus value story still intact. So growth returned about 40% last year. So growth stocks, those are your companies that are growing very fast. They're the names you've heard of. They're Amazon, Facebook, Tesla, biotech, things like that. Your value companies are banks, oil, trash companies, things like that, have had a multi-year issue, and they only returned 2% last year. Believe it or not, growth companies 40%, value 2%. Another little teaser, I'm going to get into this in our outlook for next year, but if you think that trend is going to continue this year, maybe, but it's probably not going to continue forever. So we're going to start looking at value again. Inflation was very muted at 1.27%, not a big issue on the inflation horizon last year. Overseas, we saw European and Japanese markets, the developed markets, return about 10%, and emerging markets about 15%. once again, ever since the Great Recession, the US large cap growth companies have really led the market. And I think we're going to see this COVID pandemic, while they certainly led the market through 2020, I think you're going to start to see in 2021, as economies start to resume some sort of normalcy, that some of these other asset classes are going to take that leadership. But we'll get into more of that later. But suffice to say, for now, Europe, Japan, and even emerging markets, slightly less returns than the US, but certainly catching up towards the end of the year. Cash returned about 0.4%. Not a lot of return in cash. I remember the days when you could get like 5% on a money market fund. That's not the case today. Cash really is, there's no return at all in cash. In the bond market, TIPS, Treasury inflation protected securities, as I've been saying for many years, returned about 11%. And TIPS do best in a unanticipated inflationary environment. So inflation was only about 1.2% last year, but most people think it's going to tick up a little bit. So we saw some really robust returns from TIPS. Long-term Treasury bonds, good old US Treasury bonds earned about 18% last year, believe it or not. And the total bond market returned about 8%. So once again, diversification pays off. Even bonds had a very nice return last year. Interesting though, our high yield bonds only returned about 5%, less than your Treasury bonds, which is very unusual. With the COVID pandemic and things like that, people sold off those high yield, they didn't recover. But as we go into next year, I think you'll see some more return to normalcy on that. They were positive for the year, but not tremendously so. Gold returned about 25%. Gold does very well in sort of a panic environment, which we saw last year. Gold has been in a multi-year uptrend. We're actually taking a look at it again, maybe allocate something to it. I don't know for sure, but it's certainly been doing well as governments do continue to print all this money. You see people move towards gold a little bit. I'll finish up our 2020 review here. We'll talk about real estate. So REITs, your publicly traded real estate investments trusts, actually lost 4% in 2020. A lot of panic, especially in the office space arena, with companies vacating their offices, afraid people couldn't pay their rents and things like that. And so the public REITs really had a hard time, like I said, down about 4%. Now that's been after many years of good, robust growth. On the private side, for those of you that invest with us in our private real estate investments, we saw some really good, robust returns there still. Most operators have been able to navigate, if they're good, have been able to navigate this pandemic pretty well. A combination of, some concessions, maybe getting people to sign a longer lease, some things like that. But we did see some good returns on those. A couple of themes that came up last year, though, is definitely an exodus from some of your major urban areas to some of the suburbs, to some of the mountain homes, beach properties, things like that. I know that our local beaches in the summer, in the middle of the pandemic, our beaches had the busiest summer that anyone can recall. And not only was it busy, but people stayed. I mean, people that owned houses were living there. They weren't just going down on the weekends or a couple weeks, they went there and they stayed there. So we saw some of this reversal, this urbanization. We saw rents in some of the larger cities definitely come down. And some of those trends that we knew weren't going to continue forever, some of your bigger cities, New York, San Francisco, LA, Chicago, places like that, saw people migrating out. And frankly, I'm not sure those people are going to return. They're between the companies and getting used to a different lifestyle. I think you're going to see that trend continue. Affordability was a big trend last year as well, as people maybe had their pay cut. We had some clients that were on reduced pay. Some people lost jobs, things like that. Affordability became a big buzzword last year in the real estate market. And if you had affordable housing, that's where people wanted to be. They weren't interested in overpaying for the fancy places. On the commercial side, office, still, some challenges there. Not completely decimated. There are still people needing office space for sure. Multifamily, which has been hot for a number of years, continued that. There's a lot of money in multifamily. Kind of thought that trend was going to slow down, but with the pandemic, it really kind of accelerated the money going into multifamily housing. Maybe a little bit overheated, but the real story was if you had for a strong will and were willing to, there were some really good bargains in retail. And I'm not talking about like your massive shopping malls and fancy New York City retail, Macy's. I'm talking about your neighborhood strip malls, the place with the Chinese takeout and the post office and those essential things that people want to go to, like a neighborhood, your neighborhood grocery store, around here, a Food Lion or a Harris Teeter or Piggly Wiggly, those type of places, your Dollar General stores, all those type of retail did extremely well last year. And some people panicking, calling for the end of retail. We were able to buy some of those places at some really, really good prices. And honestly did not have many problems collecting rents either. So a lot of trends going on in real estate as well. Okay, so that's kind of a summary for 2020. A lot of stuff happened last year. Let's hope that 2021 is not quite filled with as much drama, although I'll take the returns of the market, both the stock and bond market. We don't think that's going to duplicate in 2021. But in my next video, we'll talk more about the outlook for 2021.